All right, let's talk about gold. But I gotta tell you, the real story here, it's probably not what you think. I mean, get this, gold just crashed during a war. The one time it's supposed to be your ultimate safe haven, it did the complete opposite. And that single event, well, it changes everything you might think you know about gold. Seriously, this is a total game changer for investors. Okay, real quick, the usual disclaimer, this is just for educational purposes. It is not financial advice. Please always do your own research and talk to a professional. So let's dive right into what I'm calling the 2026 gold paradox. I mean, how on earth did the ultimate safe haven just fail when it was needed most? But to really get why this was such a shock, you gotta see the setup. 2025 was an insane year for gold. It rocketed up a staggering 63.7%. I mean, the momentum was just completely off the charts. Now check out this timeline. On January 29th, gold hits this crazy all-time high. Total euphoria in the market. Then, just a month later, war breaks out. This is the classic catalyst for gold, right? But instead of ripping higher, by the end of March, it had just collapsed. Yeah, that's a 23% drop from the top. Look, this wasn't some little dip. This was a full-on crash, happening at the exact moment everyone thought it should have been going to the moon. So what in the world happened? This is the big question, right? Why did gold do something that seems to go against its entire reason for being? Well, the answer. It has nothing to do with fear or war or any of the headlines you read. It's about something much more powerful that most people completely ignore. It's what I call the real yield truth. Okay, this is the biggest myth about gold, and we need to bust it right now. The myth is, gold goes up on fear and war. Simple. But the reality? Nope. Gold actually tends to fall when real yields are high and the dollar is strong. It's a financial asset, not a fear gauge. So what the heck is a real yield? It's actually super simple. It's just the interest you get from a super safe bond after you subtract inflation. Think about it. Gold just sits there. It pays you zero. So if a bond is offering you a positive return after inflation, why would you hold the shiny rock? That bond is gold's true competitor. So let's break down the 5 reasons gold actually fell during the war. First, real yields stayed high. The war made everyone freak out about inflation from energy prices, and that kept interest rates up. Poison for gold. Second, the US dollar got stronger. In a real global crisis, everyone runs to the dollar, not just gold. Third, let's be honest, after that huge run-up in 2025, a lot of the war risk was already priced in. Fourth, you had a classic leverage unwind. Traders got margin calls and had to dump their gold to raise cash. And finally, and this is a huge one, central banks in countries that import a ton of energy, they had to start selling their gold just to pay their crazy high oil bills. But here's the twist. That short-term crash, it's actually hiding a much, much bigger story. A long-term revolution, really. We're talking about central banks and how they've put a whole new floor under the price of gold. I mean, just look at these numbers. Over 1,000 metric tons of gold bought by central banks for 3 years in a row. This isn't some little trend, folks. This is a massive, historic shift. They flipped from being net sellers to being the single biggest buyers on the planet. And you might be asking, why? Why the sudden shopping spree? Well, this quote says it all. If it can be frozen, it's not yours. When Russia's dollar reserves were frozen, it sent a shockwave through every central bank. They all realized their dollar holdings weren't truly theirs if they fell out of favor. But gold, physical gold in your own vault, nobody can freeze that. And just to put that into perspective, central banks are now soaking up between 25 and 30% of all the new gold that gets pulled out of the ground each year. Think about that. A quarter of the entire global supply is being bought by this one group. That's a huge, constant bid under the market that just wasn't there before. Okay, so let's put the pieces together. You've got this incredible long-term demand from central banks, but also this brutal short-term weakness when real yields spike. That's the new world for gold. So if you're thinking about adding some to your portfolio, how do you do it the smart way? Let's get into the toolkit. When it comes to gold ETFs, most people think of GLD. It's the biggest, the most famous. It's great for traders, for options, for big institutions. But look at that expense ratio, 0.4%. Now look at its little brother, GLDM. It holds the exact same physical gold, but its fee is just 0.1%. So the takeaway here is really simple. If you're a long-term buy and hold investor, GLDM is just the cheaper, smarter choice. Period.
Okay, I need you to lean in for this next part. This is super important, a critical tax warning that could literally save you thousands of dollars. All right, here's the trap. The IRS views gold ETFs not as stocks, but as collectibles, like art or baseball cards. What does that mean for you? It means your long-term capital gains aren't taxed at the usual 15 or 20%. They're taxed at a much higher 28%. Look at the example. On a $100,000 gain, that's an extra $8,000 you're handing over to the taxman. It's a huge difference, and it's why a lot of savvy investors choose to hold these inside a tax-sheltered account like an IRA if they can.
So, okay, we've talked about real yields, central banks, weird tax rules. It's a lot, I know. So what is gold's actual role in a modern portfolio? And, how much should you even own? You can really boil it down to three main jobs. First, it's true break glass in case of emergency crisis insurance. Second, it's a phenomenal diversifier. Over the long run, it has almost zero correlation to stocks, meaning it zigs when they zag. And third, it's a hedge against currency devaluation, that slow, steady erosion of your purchasing power. So what's the magic number? Well, if you look at tons of academic research and what the big institutions do, the answer almost always lands in the same spot, somewhere between 5 and 10% of your total portfolio. Look, gold isn't there to make you rich. It's not your growth engine. It's a stabilizer. It's the shock absorber. And that really brings us full circle. The old story that gold is just about fear, it's broken. It's an outdated model. The real story is about real yields, the US dollar, and that giant vacuum cleaner of demand from central banks. So if you don't understand that new reality, you really have to ask yourself, are you investing in gold or are you just guessing?